Hello and welcome to CMC Markets Trading Outlook for the week of August the 31st, 2015. My name is Colin Szysinski, Chief Market Strategist. Our topic this week is how payrolls and FOMC speculation can impact trading across world markets. The crisis in China appears to be stabilizing for the time being, and we're still continuing to work our way through the weakest time of the year for stocks. We had a big plunge last week on Monday, a big rebound, a lot of back and forth trading, and now things seem to be settling out. And this is not unusual in the historical pattern of trading, where we often see a sell-off in the summer, whether it's July or August, and then sometimes we get a retest in September, October. This is the kind of pattern we saw in 2011. We also saw it in 1998. 1998 is particularly important because that year also coincided with an emerging market crisis. In that case, it was Russia rather than China. But all the same, so we've had a good lift up off the markets here, generally looking for consolidation over the next couple of weeks. We could still see some weakness in late September, early October. So we're not completely out of the woods yet, but so far so good for the time being. Looks as though we should, though, continue to see a lot of good intraday swings and intraday swings. So lots of opportunities for trading on both sides of the equation. The highlight of this week really is there's tons of data. It's the first week of the month, but really the focus is now turning back towards the Fed meeting in mid-September, and will the Fed finally start to raise interest rates or not? And as we've been going through here, the Jackson Hole Summit is on. Tons of Fed speakers are out speaking, and what I've seen so far is more or less the doves are still dovish, the hawks are still hawkish, the fence sitters are still fence sitting. Some of the fence sitters that have been leaning towards a hike are backing away from it a little bit. So there's a couple of things that could happen. Either one, we could get a rate hike in September, and two is we could get some hawkish dissenters in September, which could then point towards liftoff in October or December. I do still think we're going to get a rate hike this year. I think the markets are set up for it, and if the Fed was to wait too long, not only do they risk creating a bubble, they risk undermining their own credibility, because a lot of people have been expecting this for some time. And the reality is, if you're at 3% plus growth for GDP and unemployment has been falling and jobs have been growing 200K a month, and the U.S. is still too fragile to handle a measly quarter of a point increase, we've got to wonder what's going on here. And on top of that, what could happen if if a real crisis hit? Then what would the Fed do? They've got nowhere to go. At least when as an example, in 2010, the Bank of Canada raised interest rates twice. In 2015, they were able to cut it back. In 2014, RBNZ raised rates, and then they were able to cut it back. If the Fed can't stay at zero forever, and they're not even talking about going a quarter point every meeting, they probably just go one, wait a little while, and then go again. But my feeling is eventually the Fed has to get themselves back to 1%, just because they need to reload for when the next crisis hits, because, well, they always do. And so we've had it coming off of a very big week in the stock markets, and this week we kick off on Sunday with further reaction to the Jackson Hole meeting. The big speech from Fed Vice Chair Fisher is on Saturday, so the markets will get a chance to respond to that on Monday. Also Monday we get Chicago PMI. Tuesday morning in Australia, Monday night in North America, we get the Australia RBA meeting. No change has been expected, but Aussie dollar could be quite active on that because it had been trailing off lately on fears of the slowdown in China and devaluation in China, and rate cuts in China could give the RBA scope for another cut if they wanted to. We'll see if they actually deliver it or if they hint at one. The street's not expecting anything there. Generally, Australia has a big week for news. Later in the week, they get trade balance and retail sales as well, and GDP. So Australia markets could be active. We also have it's a big week for payrolls, and the payrolls are the ones that could really drive a lot of trading and a lot of Fed speculation. We get ADP on Wednesday, we get nonfarm on Friday. On top of that, we get Canada jobs on Friday, Germany jobs on Tuesday. So big week for employment data. This is typical scheduled reporting here, but we're likely to see a lot of movement in U.S. markets based on that. So not only stocks, but also U.S. dollar. U.S. dollar hits a number of other currencies. It also impacts gold, impacts commodities. So there's a lot of moving pieces and things we could see happen off of the data announcements that are coming out this week. So I thought I would, from here, do a review of some of the markets. Generally speaking, of course, the strong data would build the case for the Fed to start raising rates sooner. Weak data would suggest that perhaps they may put things off. So and so that's important to remember as we move through the trading, whether how the street will read things as hawkish or dovish potentially. Going to kick things off with crude oil. Crude oil has had a massive rally here in the last couple of days. A 10% gain on Thursday, a 5% gain on Friday, back up, blasted up through 40 here. Out of this channel, here, let me blow this up actually, here. So, big defensive trading channel, massively oversold on crude oil. What do we get here? Breakout over 30 and out of this downtrend, breakout over $40 and out of this downtrend, and kaboom. Huge short covering rally, people jumping to get back on the bandwagon and everything else, and everybody trying to get through the door at the same time. Incredible. Now, oil is running into some resistance around 45. Next one for WTI, 46.60. We've already completed a 23% retracement. That's about 43.20. So we could get a retest of this. We could get a retest of this 42, which coincides back here with the March low. But I do suspect that given the strength of the move of the last 2 days, a little bit of a correction at some point, perhaps during this week, certainly is a distinct possibility. Let's look at Brent as well, who also is having a big week here. Brent has come back up here. Brief dip below 45, support around 42.30, been back on the rebound. It clearing 45 is the trigger for it to take off. RSI is back above 50, and then the price actually is also back above $50. So we're getting a good run here for Brent. I also think we'll probably at some point see some backing and filling and more base building. But overall, for the time being, it looks as though we've got a fairly significant low has been put into the oil market. Moving now, and by the way, I'll just note here, clients have been going long here, although we are seeing a trimming of long positions in Brent, decline among top clients by 12%. That's telling me that we are seeing some people with this strong rally we're seeing here taking a bit of money back off the table, and it will just show client sentiment on Texas has already gone split. So we're seeing here number of clients net long, but position value net short. So that tells me that that some people have started to short in again against this rally, to thinking that it's probably 5 and 10% gains for more than a few days aren't really sustainable. So probably people are thinking we'll start to see a correction at some point in the coming days. While we're talking here, let's do gold. And gold, of course, tends to trade against the US dollar. So if we see anything to pointing toward a more hawkish Fed, likely to depress gold. Anything points towards a more dovish Fed is likely to help boost gold. And we saw in the last few weeks, gold had been rallying, and now it's been knocked back. When the focus was on China, gold really took off here, double top here in and around 1170, back under 1160, and it's really come back and settling out here around this 1125 to 1142 range. RSI is holding 50 though, so the underlying uptrend for gold remains intact. And if we look here, clients are still net long gold. And interesting, while the long position on oil was shrinking today, the long position on gold is increasing. So people are starting to we're seeing some renewed enthusiasm for gold today. The next thing I'll show is US dollar index here. And we can see it had been knocked down in August when the China and the volatility had people thinking, okay, well, the Fed's going to have to wait. But now that there's stability and people are starting, some Fed members are saying, yeah, the volatility is making them rethink, and some have said, no, it's not making them rethink. So we've seen here, having bounced up out of this bear trap under 93 here, we're back up in and above actually 96 now, next as we move back up into the upper half of this 94 to 98 trading channel for the US dollar index. And I'll just show here a couple of charts. Also, we have US dollar CAD, which interestingly enough is very split here. It's been in a big uptrend, but look at this growing negative Growing negative divergence on the RSI telling us upward momentum slowing. Small double top here near 133.60. Rolled back under 133, retested as new resistance, testing 131.75 support, and then next support after that in and around the 130 at 25 area for dollar CAD. And why this just above 130 is particularly significant becomes more apparent when we actually look at the CAD US dollar chart here, when we flip it over, because what we have showing here, instead of a negative divergence, a positive divergence, steady downtrend, but the support's coming in here near the 75-cent round number, bumping up against 76, and the real channel resistance it needs to clear is about 77 for CAD US dollar. Let's go down now and take a look at dollar yen. Dollar yen has the potential to be quite active as well as capital flows in and out of defensive havens. We've certainly seen it be very active in the last few weeks and may continue to be this week. So when China was melting down and people were getting really fearful, we saw this come down, which meant the yen was rallying. Now we're seeing it coming back as the yen has been backing off. And oftentimes the yen trades similar to gold. We'll look at cable and euro as well. Oh, and an Aussie dollar before I move on here. Cable is bouncing around a lot. The UK is also expected to raise interest rates at some point. Basically, this is in a channel between about 153.50 and 159. It's swinging down towards the bottom of it, where it may start to find a bit of support. Some's come in recently here around 153.40. Euro has also been very active in the last couple of weeks, trading as against the US dollar. So when the US dollar was dropping on people thinking the Fed would hold off, the euro bounced back. Then when Fed speculation of rate increases started to heat up again, the euro's been coming back off. So it popped up from around 107.50 up to around 117, almost 117.50. It has since given back over half of that. Here's a resistance level around Fibonacci around 112.85, and this moving average here, the 50-day, is here in and around 110.91, and that's the 110 round number. RSI is holding 50, so that tells me momentum is still building. This underlying upswing remains intact, even though we're seeing a correction that did take it a bit ahead of itself as it did get overbought. A final pair I will look at here is the Aussie dollar, which I said potentially could be quite active. We've got the RBA meeting, GDP, retail sales, trade balance, busy week for news out of Australia, so the Aussie dollar could be active. It's been falling in a step pattern, sell off, consolidate, sell off, consolidate, bounce bid, sell off, consolidate, sell off, consolidate, sell off, and recently it's been consolidating. If we get a cut out of the RBA, this could fall again. If we don't get a cut, this could bounce back. Support's been moving in here. This is 70.60, and this in here is about 72.20, and this is the zone of trading we're starting to get here. Which way we break out will depend on two things: one, the Australian data, and two, what the RBA does. Interestingly, and keep an eye on what they say, because last meeting we actually had gotten a little bit of a bounce here in the RBA for a couple of days. The RBA finally backed away from trying to talk down the dollar. If they back away again from taking pot shots at the currency, would also be supportive. If they come back and start going negative again, could push it. And don't forget here, this big 70 round numbers looming, so that's quite important as well. Just going to talk now about a couple of indices. We'll start with the Chinese indices. We'll do the Hang Seng here. Still very active. Huge sell-off. We're getting a bit of a pop, but each time we get it, we get a pop one day here, pop one day here, and then it otherwise struggles. So it's still hard to tell if this is early base building, pause in a broader downtrend. This number here was 28.25, and up here is about 22.140, and 21.600 is here on this line, and this is the 21,000 even level here. Let's go on and talk about U.S. markets. We'll look at the U.S. 30 here. people are still short. And even though, interestingly, even though it's had a pop for a couple of days, we're actually seeing bearish positions increase. So people aren't believing this rally. They're figuring probably that, okay, well, we've had a couple of good days here. This rally's not sustainable. Yes, we are still in this choppy period we could see in the markets for some time. So we've probably got some bulls taking off the table, bears shorting the rally, and so we're still seeing some consolidation here. We're shorted this 16,835 Fibonacci level. We're also, I'm just going to make a switch here on this. We'll draw it in this way, off this low. So here's what we got. If we look from the peak to the trough here, the peak being back in May, and we've completed a 23% retracement, completed a 38, had a nice run here, but we have had a good pop. We are seeing a bit of profit taking here, but look at this though. It's holding this 38% retracement level, 16,475. The 50 is 16,835. So we could see some backing and filling in here, but this is supportive of a rebound. Let's look here at the Germany 30. Another one, big drop here, and if we look at the Fibonacci's, cleared the 23. That's a different Fibonacci, but interestingly enough, we've run into resistance at it near 10,360. Support has moved up towards 10,175. Next resistance 10,4093, and a cluster here in and around 10,850. And the final one I will take a look at here is the UK 100. Another one that's had a good pop here in the last few days, and look at this, it's now running into this Fibonacci level here, 62.55, 60, this here is 61.40 and 61.05. So we could see it possibly start to consolidate in this zone here. So there's still a lot of moving pieces in world markets. There's a ton of data out this week, as is normal for the first week of the month. A lot of real focus on it as people try to figure out whether the Fed's actually going to raise interest rates or not this month. We're coming off a hugely volatile week. While this week may not be quite as volatile, we're still likely to see some fairly significant swings, both upwards and downwards, that could potentially create opportunities for trading.